Your Lending Era, the podcast where we dive into the world of residential, business and commercial finance, bringing you expert insight, tips and strategies to help you navigate the intricate landscape of lending in Australia. I'm one of your hosts, Jessica, and in today's episode we will be dissecting all things residential lending to try and clarify what products and features may mean to you. Here with me today we have Trilogy Funding's Managing Director, David.
Hey Jess, how
Hey
are you?
Dave, I'm good, and Hope Westbury, one of our financial strategists.
Hey Jess.
G'day, how are we feeling, guys?
Good.
Ready for another week?
This is kind of our bread and butter today. We're just going to be going through almost a glossary of the terms and kind of the features that you would see on any bank's website.
Correct. And I think it's important to do this because when you are going for your first home loan or you're talking to friends and family about finance, everyone's got an opinion.
Yeah.
And it's an opinion that's relevant to their individual sort of circumstances or situation.
Yeah.
And it might not be right for you. And in a lot of the times when people come in with info, it's all incorrect. Terms are wrong, so let's run through it and clear it all up.
It might not just be right in general.
Yeah, correct.
It might be irrelevant even to your circumstances altogether. So there really is kind of a glossary of 10 or so kind of phrases that we would normally use throughout a loan process or that would be applicable to someone. So right off the bat, we'll start off with the most common kind of loan, and that is an owner-occupied loan.
Yeah, so it just off the back of what Dave said, because we use this jargon every day, I forget that a lot of people don't actually know what these terms are, which are simple to us, but maybe not to other people. So owner-occupied loan is a loan that's secured to your principal place of residence.
Okay, so as simple as that, it's just a PPOR, as we would say, just an acronym for you. It's a loan for home for residential purposes.
Correct.
Okay, and off the back of that, what is an investment loan, David?
So an investment loan is any loan used for any investment purpose. So this might be a loan that you've taken out to buy shares, a loan that you've taken out to buy a share of a business, a loan that you've taken out to be the deposit on an investment property, or even the loan for the investment property itself, right? So now it's all about the purpose of the borrowing. So the first couple of loans that I mentioned there, they could all be loans that are attached to your primary place of residence. But they're not home loans, they're investment loans because they have a different purpose. Usually these are loans that you want marked as an investment loan. You want the statement to potentially say investment loan because you're going to claim it for tax at some point in time.
Okay, so an investment loan really could be against an investment property or your home, but it just has to have a specific purpose.
Yeah, it's all about what you're going to use the money for.
Oh, okay. Well, that does make pretty good sense. And look, I will say, guys, some of these things you're going to listen to and be like, this is snail mail. Like, we already knew that. But please bear with us because there are some things down the line that may actually be quite valuable to even an avid investor.
Yeah, let us get into the good stuff.
Yeah, okay. So getting into some good stuff here, let's talk about the two main repayment types. So we'll start off with principal and interest-based lending.
So principal and interest is typically what you would have against your home, so the primary place of residence. And essentially what that is the loan is made up of two portions, which is the principal and the interest. I know that it sounds super simple, guys, but I'm trying to break it down because some people don't know this stuff. So essentially when your loan's on P&I, acronym, then essentially every monthly repayment that you're making, the principal is coming down and you're reducing that overall loan balance.
Okay, so a principal and interest repayment is you're reducing your debt, but you're still obviously being charged interest.
Yeah,
yes, correct.
as you go. And that principal and interest loan will have an amortisation schedule, which looks like a big curve.
Yeah.
And you'll see that as you make the same payment over that amortisation schedule, in the early years you're paying more interest than you are principal, and in the later years you're paying more principal than interest. So that's why it kind of curves off like that.
Okay.
And there's really cool diagrams that we can provide the client to show
that schedule.
when that curve really starts to kick in.
Okay, and you mentioned that principal and interest loans are generally on a home, but can they be on any debt?
They can be on any debt. You can have them on investment property. You can have them on. They're very, very much used on commercial property.
Yeah. Okay.
Because commercial property usually has very high yield, and the idea is that you kind of want to pay down the debt or pay off the debt. So you can use a principal and interest loan at any time. Yeah.
Okay, and there's certain securities, like you just mentioned with commercial, certain banks will want certain properties like a small apartment to only be P&I to make sure that they can always recoup their investment.
Yeah, correct. So there's definitely instances where it's more appropriate to use a principal and interest loan than it is to use an interest-only loan.
Okay. Oh, segue from Dave.
There we go. I
Segue.
set you up for that one.
Oh, set and swing. Okay, so now we'll go straight into the opposite of principal and interest lending, where you're paying down the debt and interest to interest only.
Yep. So interest only is usually used for investment loans. And the reason it's usually used is for two reasons. So number one is for cash flow.
Yep.
Obviously if we're only paying the interest component, therefore it's going to be cheaper than paying a principal and an interest component. The other one is for taxation. So if you've got a tax deductible debt, you may not want to pay that debt down, because every time you pay it down, you're getting less of a deduction in the following year. Also, if you've got, and it's about what's more appropriate for you. So if you've got a principal and interest home loan that you're trying to, non-deductible debt that you're trying to get rid of, then your investment debt, it would make sense that you made lower payments on that and higher payments on the non-deductible home loan. So it just helps you, sometimes interest only, just helps you hold a debt until it's the right time to start to want to clear that debt.
And just on that, guys, referring back to the owner-occupied home, the primary place of residence, then it's really difficult to have interest only secured to that, as with the purpose of that just being your home loan.
Yeah. So banks will do some small amount of interest-only borrowings for home, but they more want to do it for set of circumstances. So, if you're in a situation where there's a period of maternity leave that's coming up and, you're going to have 9 months of reduced income and you want to change that back to interest-only for a period, you can do that, but you're right. The majority of lenders want that on principal and interest nowadays.
Pay that debt down.
And I know with interest only, we see this quite frequently, is when an investor will purchase a property and put it on a principal and interest repayment, and only 6 or 12 months down the line, their accountant wants them to do the opposite and not pay down the debt. Am I right in saying it's easier to get a loan on interest only up front and then revert it to principal and interest than it would be the other way around?
Correct. You can make the decision to move from interest-only payments to principal and interest repayments at any day within the loan term. You literally wake up in the morning, ring the bank, and they're more than happy to move it to principal and interest.
Yep.
But the other way around, so if you've got a principal and interest loan and you want to make it an interest-only loan, that's a credit-critical decision. Yep. The bank needs to do certain servicing calculations to make sure you can clear the debt when it goes back to principal and interest. So therefore, that is usually with most lenders a full loan application.
Okay.
So easy to go one way, very hard to go back.
And you've just touched on the remaining loan term. So how does interest only impact the remaining loan term once it expires?
So the majority of interest-only loans are actually structured as a principal and interest loan over, say, 30 years that has a 5-year interest-only component at the front. So you're in fact having 5 years interest-only term followed by 25 years principal and interest term.
To pay that loan off.
To pay that loan off. And you need to meet the debt servicing calculations of the 25 years principal and interest at the servicing rate. Okay. So obviously the 25 years principal and interest has a higher payment figure than 30 years principal and interest.
Definitely.
And that's the calculation that the banks need to do.
Yeah.
Okay, and on the back of the interest only and the P&I, now we're going to talk a little bit about the types of securing an interest rate. Now, we've all seen fixed rates go to staggering lows in the last 3 years and now to highs. So let's talk a little bit about the benefits of a fixed rate and even just what it looks like.
So a fixed rate can be principal and interest, can be interest only. It can be on owner-occupied, can be on investment. Obviously, depending on what it is, then the rate will vary. But fixed rates essentially secure a set rate for a set period of time. Okay. So this is really beneficial for someone like a first home buyer who is entering into the property market for the first time. They've taken on, hundreds of thousands of dollars worth of debt, and they just want to make sure that they can sculpt their monthly budget and know that that's not going to change. It's just going to have that real certainty of repayment, because with the rate being fixed, it's going to be the same every single month.
Okay, and that's probably similar. I know we were having this discussion yesterday. That's very similar to a car loan for most people, isn't it? Yeah. Just a set repayment, 60 months worth.
And that's why first home buyers quite often like a fixed rate loan, because the only other product that they have had in lending terms before that has either been a personal loan or a car loan, and they're always a fixed rate product, vast majority of times. So when they come into you and they're borrowing 10 times more than their last car loan, and you say to them, okay, and if the RBA changes the rate, it changes your payment, they have a heart attack and they go, I can't deal with that. quite yet, right? I'll deal with that in the future, but can I just know exactly what my payments are going to be in my new home for the first 2 years?
Yeah.
Okay.
Which is fair. It's fair and reasonable if you're adjusting to new expenses like rates, water, electricity that you haven't previously paid.
First-time investors as well, they like to take a fixed rate because they know what the rent's going to be. They know roughly, they've done their homework, they know what their property management expenses and outgoing costs are going to be. And if they can fix what their interest cost is going to be, then they can work out what the property is going to cost them or how much it's going to make them and then how much that's going to affect their tax. And they can do that all for forecast that out for the first 2 years, get their foot in the door with that first investment property as stress-free as possible.
Okay, so it's good from a planning perspective and a forecasting, but let's talk a little bit about some of the cons of the fixed rate, because I know that they can change literally at the drop of a hat.
Yeah, so there are a few cons associated with the fixed rate. So unfortunately, because it is fixed, you have made an agreement with the bank that you're going to stick within those set parameters for 1 year, 2 year, however long you've fixed in for. Yep. So if you do break that contract with the lender and say you need to sell the property or something to that effect, you will be penalised for that. So there sometimes can be substantial fixed rate costs associated. You also can't have different features with these loans with most lenders. You can't have, like, say, an offset account, which we'll go into what that is later on, but just things like that. And obviously, if you do pay above and beyond, I think with most lenders, as a general rule of thumb, it's about $10,000 additional per annum on top of your minimum monthly repayments. Yeah. You will also be penalised for that as well.
Oh, wow. So you're penalised for trying to get ahead.
Yeah.
Oh.
What a way to put it.
Wow.
Yes.
I know, it's so negative. Yeah. Okay, and let's talk a little bit about the ever-changing fixed rate. So it's not really spoken about too much, but if I were to apply for a home loan today and the fixed rate is, let's say, 6%, I'm just making that up, but if it was 6% today, but I went to settle and the rates have changed, I would then be liable for the new rate potentially rather than the one of today, wouldn't I?
Yeah, that's right. So there is something that can help us avoid this happening, and it's called a fixed rate lock. Yeah. And it's a percentage that you pay to the lender to ensure that you receive the rate on the day of settlement on the day that you apply. Mm-hmm. But there is a fee associated with that, somewhere around ballpark $750 to $1,000.
Oh, wow.
Yeah. So we obviously do math and numbers for clients, because if you've got to pay a $1,000 fee and you're fixing a $200,000 loan, look, the rates need to move a lot before you can justify that expenditure. Mm-hmm. Yeah. So I think with fixed rates, have a chat through it and make sure it's going to be appropriate for the set of circumstances. And it can be a good option.
Yeah, and definitely one thing that I know that we saw a lot of kind of throughout COVID, sorry to mention it, were the fixed rates being so low. So we had clients who were paying 3% and 4%, which even today, as of, writing in 2023, sounds super low, 3% and 4%. But a lot of those clients were wondering if they could just move on to the new like 1.99% fixed rate. And the break costs in that were astronomical, weren't they?
Yeah, they were.
You don't have as much freedom on a fixed rate, but you do have the positive of being able to budget, which I still have to appreciate, even though I'm a bit negative about it.
And look, at the moment, everyone who's got a fixed rate that took it out in COVID for 3 or 4 years is just laughing. Yeah. But historically, that hasn't been the case. Usually, it's a 50-50 chance whether you're going to save money on a fixed rate. I typically say to clients, don't fix because you think you want to save money. Fix because you want consistency of that payment.
Yeah, definitely. And actually, on that fixed rate, what is this fixed rate cliff I've been hearing about in the media?
That's exactly what I was just saying, which is just this large amount of people that took fixed rates in COVID, and they're now rolling off fixed onto variable rate loans, and at whatever those variable rate loans are. So currently we've got clients that are going from 2% fixed to potentially 6 or 6.5% variable.
Yeah, so that's tripling the interest that they're paying annually, isn't it?
Correct.
That is chaos. I could not imagine.
Yeah.
Okay, and now let's talk on the flip side of a fixed rate loan. Let's go back to the squeaky clean variable rate loan.
So Australians love a variable rate loan.
Love a variable
rate loan. We're kind of carefree type people. We love just to ride the highs and lows.
Ride the wave.
And, why not?
As a nation, we have probably one of the highest rates in the world when it comes to take up of variable rate loans. Europe and America and Canada, they love a fixed rate loan. Australians love a variable rate loan. So what a variable rate loan is, your loan is kind of pinned to the RBA's rate. So if the RBA goes up, chances are your loan is going to go up. If the RBA goes down, your loan's going to go down. So, and with that, because this is the product that most people use, it's also the product that has the most amount of features. So, we get into, the package products and the basic products and the offset and redraw, which we'll cover off shortly.
Yeah, okay. And the variable rate, so Hope did mention that the fixed rate has some caveats in terms of repaying it early and exit fees. Are there any additional fees on a variable rate if you did want to do anything, out of the ordinary?
With most lenders, you can pay them off or pay them down or make extra repayments without any penalties whatsoever.
Okay, so variable is probably flexibility, whereas fixed is certainty.
Correct.
Beautiful. And let's talk a little bit about combining the two. So a lot of first home buyers especially love this one, and that is a split home loan.
Yeah, so sometimes we can do a split loan where, take your example, Jess, we've got a first home buyer that's come in and they're borrowing $500,000. So we can actually split that $500,000 into two separate loan splits and have one of those loans on fixed and the other on variable with, say, to utilise an offset account as well. So it's literally giving them the best of both worlds.
Oh, who sings that song? Is that Lizzie McGuire?
It got the best of
both worlds. It's Miley Cyrus. Yeah, it's Hannah Montana.
Dave's like, what are you talking about?
Yeah, no, that was just a real brain moment. It was nostalgic. But yeah, so the best of both worlds with a split rate home loan. You can get the certainty of fixed, the relaxed kind of laid back ability to ride the wave in Dave's terms of the variable loan, but all within the one property, correct?
Yeah.
Great. And now moving on to the package product versus the basic product. I know Dave did a little teaser to that a moment ago. Let's go into it.
He's good at that.
So it comes to what's appropriate for you. So we'll go back to the kind of first home buyer chat before that we were having. They used to having, a car loan or a personal loan, and that was fixed rate, and it was you just made your payments and that was it. So when they go to buy their first home, they actually most of the time look for a similar type loan. Okay, so they don't want a whole heap of stuff. They just want a good rate, low fees, and the ability to make payments. So a lot of basic loans are used by first home buyers because they're the kind of cheap and cheerful, type of option. However, when they get a little bit older and they've got money sitting in a transaction account and they're used to having, a credit card that has frequent flyer points and all this kind of stuff, they tend to migrate into what's known as a packaged product, which is where the bank gives you offset accounts and, credit cards as all part of your home loan package and charges you an annual fee for having all of that banking together.
Okay, and the annual fee does cover, like you said, like a wide range of services within that one bank, though, generally speaking.
Correct, all within the one bank. So you might have, certain banks might charge you, $8 or $10 a month to have an offset account. Certain banks might charge you, $395 for, a rewards points or a Qantas reward points credit card. So what a package is they say, okay, well, there'll be no application fee on your home loan. There'll be no application fees for top-ups or increases. There'll be no credit card fees. There'll be no valuation fees for your home. Yeah. There'll be no offset account fees, but we're just going to charge you one flat fee per year. And whatever you want to do, we'll cover under that fee.
Okay. And like you said, sometimes obviously one would suit one person very specifically and the other wouldn't, but it does just come down to the individual needs, circumstances.
Yeah, correct. It's just what is best suits you, best interest, Judy, is what we would recommend for a client.
I think it's a cash flow thing too, right?
Yeah.
Like first home buyers, like take me for example, when I bought my first home, I did not have thousands of dollars extra to put in an offset account, and so that wouldn't have suited me at all. No. There would be no point in me paying a $395 annual package fee to utilise those features because there's no money that I would have been running through that at that time.
Yeah. Okay, and let's talk a little bit about, so on the back of the package, Dave, you mentioned the offset account term. So let's talk a little bit about what an offset account is, Hope.
So an offset account is something that I find a lot of people don't know what this is or how it works. And the way that I explain it to my clients that come into the boardroom and sit down with me and say, Hope, I'm really embarrassed, but I actually don't know what an offset account is. And I say, right, so if you've got a loan for $500,000 against your home and you've got an offset account which looks like a very standard transactional savings account on your online banking which is linked to that home loan and you've got $100,000 worth of your savings sitting in there, it offsets the $500,000 loan. So essentially you're just paying interest on the difference, which is $400,000. And what that does is it helps pay the principal balance of your home loan down a lot faster. It doesn't change your monthly repayments in any way, but when you see the interest coming out each month on your statement, on your home loan statement, you will see that the interest is being reduced every month, the more that you have in that offset account.
Okay, and so if you did have an offset account, for example, with $100,000 in it, what a lucky chap, and then you were to, say, take out $50,000 to buy a car, your repayments would stay the same, but the interest would increase.
That's right, yeah.
And some banks even have on the statement, this month your offset account saved you X amount of dollars in interest.
That's motivating, isn't it?
Yeah, it is. And the calculations usually run on a daily basis. So as soon as your pay hits the bank account, it's offsetting your home loan.
Yeah.
Oh, I love that.
And I see a lot of people come to me and they've got, say, $50,000 sitting in a completely different bank and their home loan somewhere else. And I'm like, okay, we need to marry these two together and get it, working in a way that's going to save you a lot of money on interest and help you pay your home loan down. And that is the ultimate goal at the end of the day.
And I know we get a lot of clients who, for example, don't like to share their finances with their partner. I know me and my partner have our own savings accounts, all of those things, but you can still have offsets in a singular name attached to a joint loan, can't you?
You can have multiple offsets depending on which lender you're at. You can have multiple offset accounts attached to the home loan. So it could be, the account that you pay bills from, your savings account, accounts for the kids, all of those types of things, and they can be in separate names.
And you could have one offset account that's nicknamed you and another offset account that's nicknamed Kyra, and it'll all still work, right?
Yeah.
Oh, you've jumped into my personal life. No, I'm only kidding. But no, it's good. So in terms of wanting to keep your finances separate, not using an offset account, it's not really an excuse anymore. You still can find a bank that will allow you to do that. And why would you want to not, why wouldn't you offset it?
I think it's because people don't know how offset accounts work, and they're probably too embarrassed to ask. That's the feedback that I receive anyway, and so I explain it to them how I just have, and they're like, "Oh, we need to do that. We've got to jump onto that because it would literally just be silly not to."
Yeah. And I mean, David has said it before, but you don't know what you don't know with these things, and they don't teach us this at school.
No, they don't.
Okay, and off the back of an offset account, let's talk about kind of the fee-free, generally speaking, of course, version of that, which is just a redraw facility.
So redraw facility exists on most basic loans, and it's usually, with most lenders, it's a free service. And what it is whatever you've paid in advance into that loan, you can take back. So if you've been making advance payments of $1,000 a month and you've been doing it for 12 months, and then you've got an overseas holiday and you need $10,000 of that back, you can literally just transfer it back out of the home loan into your transaction account and go and book your tickets with it. A lot of people do use this in either just as a redraw or in combination with offset. So I've got clients, and I'm one of these people. I don't want to log on to my internet banking or go to the ATM and see a large amount of money there. I want to see enough that's going to pay my household bills for the next couple of months. Yeah. But whatever surplus savings I've got, I will immediately start paying into loans, and then the money is there in offset. I know I can get my hands on it, but it's just not in front of me all the time.
Yeah, okay. So you're someone who, for example, which is a good point, you can still use offset and redraw in sync with each other. You can
use offset and redraw in sync with each other, or you can just use redraw, or you can just use offset. Just depends on the way you mentally deal with your money and your banking.
Yeah, okay, that makes sense. Now, to tie this all off, it's a topic that we all wish we could do sooner, and that is repaying off your loan, home loan, investment loan early. Let's talk a little bit about the limitations at times with doing that, and if there are any fees and charges that we need to consider.
Yeah, so the ultimate goal is to pay your loan off, especially if we can help you to do that early. Unfortunately, if you do win lotto or receive an inheritance or whatever the situation may be, if you do dump a lump sum of money, hopefully on a variable rate loan, so that you're not penalised with fixed rate costs, then there will be fees associated with that.
Yeah.
So say it is just a variable rate loan, there will be a discharge fee, and there will also be government fees as well that you'll need to pay in order to discharge that loan from the lender, get the title for the property, and move on with your life. Happy days.
Okay, and in terms of even just paying down my loan, would that look like there's also those affiliated charges? Let's say I'm only paying down my $500,000 loan to $250,000.
If you're not discharging it, and if it's on a variable rate, then there shouldn't be fees associated with that.
Okay, so that's kind of another caveat of the fixed rate loan, it sounds like, isn't it?
Yeah, because as I mentioned earlier, most fixed rates you can't pay above and beyond an additional $10,000 per annum. So if you were to dump a couple of $100,000 onto your fixed rate, probably not going to look too pretty on your bank statement.
No, little $20,000 bank fee.
And we don't want that to happen. But hey, like if you do receive an inheritance, if your situation does change, then, just have a chat with your lender, with your broker, and you can sit down and work out what the best way forward would be.
Yeah, so there's potentially an opportunity cost, but you've still got to have the discussion to see if it's worth pursuing.
Yeah, correct. Get some advice.
Get some advice, mate. Dad advice.
Dad advice.
Okay, well, one quick disclaimer again at the tail here, guys. So when we are talking about all of these terms, it is just in a general sense. Certain features and products may, at a headline level look like they would be suitable to you, but there's no way to know until you do actually talk to someone to see what the benefit would be there in doing so. With that in mind, if you do have any questions at all or need to talk to anyone about any of this, get in touch.
Yep, log on to the website, set yourself an appointment, or you can even reach out to us on Instagram.
Yeah,
Instagram.
at Hope Westbury.
Yeah, at
Jump
Hope
on.
Westbury, at Mortgages with David Thomas, I believe.
Correct.
And I'm not a broker, but my handle is Jessica May_Graves.
Go, girl.
No, I'm just kidding, guys. If you do want to get in touch with any of us, it's a quick Google search of Trilogy Funding Deakin. That's DEAKIN. You'll be taken to our website, which is a beautiful orange and black kind of theme. And it does have, I think it's Mount Everest on the front page.
Is that what the mountain is?
I'll have to find out what mountain it is. You've put me on the spot. Nice. I can't remember.
I don't know, but you can definitely book in and get a free consultation with any of, not any of us, not with me, with David or Hope or any of our team, to chat all things finance, all things features and products to do with your home loan and just dissect it a little further. Yeah.
Sounds
Absolutely. Great. I mean, we do this every day. This is what we live and breathe. And a lot of people think that it's, embarrassing to ask these questions. But I would be happy for someone to reach out to me and say, hey, Hope, what does this mean? I'd be like, mate, we can have a chat. Absolutely.
And I know a lot of people, will see this little shameless plug and be like, oh, gross, they're advertising themselves. But really our mission statement is to try and make sure more people know these things so that they can set themselves up for financial freedom in a quicker manner than they have been.
Yeah, we love to see people win, and that's what it's all about.
Mate, win. Sorry, guys, I don't know what's gotten into us today. But anyways, thank you very much for joining us today. As always, if you do want to get in touch, our links will be in the show notes, or you can just go to our website as we've just spelt on out for you, and give us a follow over on Instagram at trilogyfunding_CBR. Have a good one, guys.
Nice. Awesome. Thanks, Jess.
Thanks, Jess. Bye.
Bye.
We acknowledge the traditional owners and custodians of the land this podcast is being recorded, the Ngunnawal people. We pay our respects to the elders of the Ngunnawal people, both past and present.